Well, it's very interesting. We step back, what is it, a couple months or so, and we look at, the Saudis coming in and buying almost 1 million shares of SLV, and that's a pittance relative to their liquid capital, but yet it's enough to, raise some eyebrows and ask the question, are, sovereign nations coming in the silver market? And the answer is yes, in a very light way. But the more important part of that is they are big enough of a purchaser to be able to demand physical silver.
Something big just happened in the silver market, and it's shaking the global financial system to its core. Overnight, the exchanges doubled margin requirements, killing a rally that was threatening to expose the entire bullion banking system. It's the same move they used in 2011, but this time it's different. Sovereign nations like Saudi Arabia are stepping in, quietly buying silver through SLV, and some of them may soon demand physical delivery. David Morgan warns this could ignite a battle between paper manipulation and real-world demand, and the outcome might change silver forever. Let's go back to the interview.
Which, if you think about it, could put some heat on the silver shorts because now you've got a nation state that owns part of the SLV and they say, hey, here's your shares back. I want to cash it in for real silver. So that's a bit of a, I'll call it a threat. At least it's a bit of something that would make them think about it. So now what you do is, well, you short the heck out of the stock, the SLV, and you get ready to move the commodity down. And how do you do that? Well, that's pretty simple. It's been done again and again and again. And that is you keep selling more silver on paper that doesn't exist until you get pressure to move the price down. But if that doesn't work or isn't working as well as it normally does, you raise the margin requirements. So now if you've got to put up 10%, you raise them up and you got to put up 15%. And if that doesn't work, you raise it again to where you got to put up 20% of them. And if that doesn't work, you raise it to you got to put 30%. And if that doesn't work, you put it up to 40%. So you keep taking out the little guy, especially, and even some of the trading funds that say, I'm out because I can't put up that much cash or I don't want to, or I'm going to take a profit here. So it adds to the selling pressure. So that's what I expect to see here shortly is that there's more margin, requirement going in. And what could happen, and I want to emphasize the word could, not would, because we're getting into new territory. We're pushing toward 50. The market's acting stronger than many believed it could or would. And we're seeing pressures like you just mentioned, the SLV, the retail market outside of the United States, and something is definitely going on in the silver market. So moving on from there, what if we're in a situation where the demand for silver blocks physically supersedes or overrides the paper market? Where I don't care how much you short, give me the silver, put up or shut up. I need it and I need it now, and I'm paying a premium for it. Give it to me. We have a delay. And I'm not saying that's what's happening, but it's acting as if something like that is taking place. I don't want to be overly enthusiastic here. I want to try to remain objective and level headed. But the facts are, as you outlined them so eloquently, we got backwardation, we got retail purchases, we got people shorting the SLV shares and they can't short anymore. What happens when you sell, and it doesn't take the price down? Well, that's kind of what they're doing in the SLV. They're selling as much as they possibly can and the price is going up. That's a head scratcher. It always worked before. Why isn't it working now? Yeah, that's a great question. I wish I had an absolute answer. I don't have a feeling, but if there's, I'm not trying to brag here. It's just a fact. I mean, there aren't too many people sitting in my position that have been around or in this market for decades, and I have. And you kind of get a sense of where the market is or where it's going. It feels as if it's a little ahead of itself. But Alan Hibbert and Mike Maloney did an update. They do several. They do maybe one a day. I don't know. I don't watch them all, but they did one on why it's different this time. And Alan showed how many days above 40 silver has traded in the past. I don't remember the exact numbers, but I think in the 80s it was like 7 times, and then in 2011 it was like 17 times. And if I remember correctly, this time it's at like 20 already. So that's what you want to see for a strong market. You want to see that 40 handle isn't a 1 day or 1 hour event like the $50 mark was in 1980. Yeah, it hit 50, but it was not there sustainable. But now we've sustained 40 longer than we ever have in the past. So the long answer is we are where we are. We may just blow through 50 and keep on going, which would be extremely detrimental to the shorts right now because they're betting with they're short in the SLV, what they're doing. The committed traders look favorable to them, but not at an extreme. And they're doing whatever they can with this margin thing that they've only upped once. I wouldn't be surprised to see margins go up today to get control. If that were to go the other way, as I out, then there could be someone leaving the fold and saying, I'm going to buy back my short. I can't take the pain. That is very, very rare, but it could. So if one of the four major bullion banks that historically have huge short decides to bail and say, I can't take it and going to buy it back, well, that's buying pressure, not selling pressure. So the answer is, I don't know. My gut feel is that it's going to go a little higher, maybe hit that 52, 3, I don't know. And then all of a sudden they win and they do enough with margin requirement to bring the market back down. I mean, I'm doing that based on probability. Every time you've seen a market do a runaway, like Palladium did in the early 2000s, they upped the margin requirements to got to be where you had to have cash only for a margin. So in other words, if silver is a 5,000 ounce contract and it's at $50, what is that? 50 times 5,000, 250 grand. Is that right? Do the math right. Anyway, so instead of putting up 10% or putting up 25,000, you got to put up the full amount. You got to put up the full 250K. Well, that's a cash market. So they're forcing the futures market into a cash market. They did that in Palladium. And guess what? It wasn't enough. They actually got it above. So I actually had 4 contracts on in Palladium. And I forget where I bought, but it's like, but it was 200, went to 300. And my broker called me and said, you got to put more margin. More margin. I'm like, are you kidding? I wanted to buy more. I was thinking, I'm forward a low base. I could add runners very conservatively with all the extra cash. I was, oh, no. It doesn't matter. You're winning. You already got all this extra cash. Futures. The margin requirements are going up across the board, long or short.
David Morgan begins with a revelation few noticed: Saudi Arabia quietly buying almost 1 million shares of SLVA. To most investors, that's a small number. But for a sovereign nation, it's a signal. A sign that the wealth of oil-producing nations is starting to flow into silver, and not for short-term speculation, but for real ownership. Because as Morgan explains, those shares can be redeemed for physical metal. If even one nation demands delivery, it could trigger a wave of panic among short sellers and expose how little real silver exists behind the paper market. He lays out the classic playbook that bullion banks always use when silver starts running. They short the SLV. They flood the market with paper contracts that don't actually exist. And when that doesn't work, they pressure the exchanges to raise margin requirements, forcing traders to post more cash just to hold their positions. From 10% to 20% to 30% and then 40%. That doesn't happen to protect the market. It happens to force people out. Smaller investors get crushed, hedge funds pull out, and the selling cascade begins. But this time, something feels different. Even with heavy shorting, silver prices continue to rise. Physical demand is overwhelming paper supply. Industrial users are locking in long-term contracts. The solar industry, EV manufacturers, and even national mints are competing for the same ounces. And retail investors across Asia are paying premiums just to get bars and coins, because delivery times keep getting longer. Morgan says the market is showing signs of a structural shift. Silver has now held above $40 longer than it ever did in 1980 or 2011, a sign of deep, sustained strength. If the past was built on hype, this time it's built on necessity. Silver isn't just an investment, it's a critical industrial metal, a monetary hedge, and a strategic asset. He warns that if even one of the big bullion banks finally breaks, one that's been shorting silver for years, and decides to buy back its position, that could set off a chain reaction unlike anything we've seen. A true short squeeze. Prices could rip past $50, maybe even higher, because the physical supply simply isn't there to cover those paper bets. And now, the most telling sign of all, backwardation, when the spot price is higher than futures. That means investors are paying more to get metal now, rather than waiting months for delivery. It's a market screaming, I don't trust the paper anymore. Morgan explains this is a dangerous signal, shows fear, shortage, and a potential breakdown in confidence in the entire paper-silver system. If this continues, he warns, it could mean the end of the paper era and the beginning of a new physical reality where ownership, not leverage, decides the price of silver.
And I learned that one the hard way. That was, like I said, I've been trading futures for quite some time. Didn't know that, but that's what can happen. So all I'm saying is caution is here, especially if you're on leverage. If it were me and I was holding any contracts, 110 or 100, I'd be lightening up or getting out for now, taking the cash profit, taking that cash physical silver, standing by and wait and wait. Now, if it goes to 60, then having said that to you, I'll get a lot of hate mail. But, being in this game for a long time, it's always good to sell in the strength, because once you start getting that point where the market does reverse, that's hard to sell. Now you're selling into a lot of sells, which begets more selling. So where are we going? I'll say it again. I'm not sure, but it certainly is acting like it wants to go higher from everything we've talked about from the initiation of our interview. Normally, where they've been and what's always worked, it's called going to the well. I don't know if you know that expression, but you go to do what always works so many times, and then you go back to the well and it doesn't work. And that's a shock. Now you don't know what to do. Wait a minute. This is my last resort. Always happens, always works. And it's not. Now they get a little bit panicked. And that's why you could get in a position where one of these bankers says, you know what, I'm getting out, man. We are eating big time. We shorted at 42. We added more shorts at 44. We creamed it at 46, and now we're pushing 50. I'm not saying that will happen, but it could. Well, there's a term for it, and it's called backwardation. And what it means is exactly what you said. Backwardation means that there's the spot price, what I can pay for today to get the product, be it wheat, rice, soybean oil, or silver, is higher than something in the future. Now, just to belabor this slightly, Danny, because I don't know the level of all of our viewers, but the futures markets in all aspects go in what's called contango, which is the price today is lower than the price in the future. And the future price is usually determined by the interest rate on the 10-year note, 10-year bond, for example. So if you've got a yield of, and this is a rule of thumb, but generally, if you're going to buy something in the future, it's going to cost more today. That backwardation means that I've got to have it. I am willing to pay up. I'm willing to pay beyond, a future price to have it today.
Wow.
So it means there's a strong immediate demand. Buyers urgently need the physical commodity, be it oil, metals, or grains, now, not later. It does indicate supply tight, inventories are low, and it's hard to get to leverage. And then there's fear that comes into it, fear of a shortage. Traders that on this end may worry about running out of supply. So maybe there's someone out there that's stockpiling enough silver for their solar panel demand, and they got a delivery coming up and they're not going to get it. Implication for the precious metals is suggest that buyers doubt whether they can get real later. And this happens. I'm not trying to make a case. Oh my goodness. It's happened several times. It usually lasts a few days, and then the market goes back into contango, which is the normal cost does today. However, persistent back. So let's say it goes like a week straight. That would be that would indicate a distrust in the paper. They're not trusting the company. They're not trusting the LBMA. They're not trusting their counterpart has it stored a brokerage account. I don't want my metal. I don't want it now. So practical meaning for investors, for a futures trader, backwardation means that you can sometimes profit by rolling the contract, selling the expiring contract higher and buying the next cheap. And that happens all the time. And that's why it usually goes back into tango. So basically, wait a minute, my car could get me, 8,000 today, and I can buy it 2 months from now for 7,000. I'm in, baby. Hey, sell the car, man. I've already got it locked up for $1,000 profit. And that does take place. Yes, silver market. However, having said all of that, Danny, and I'll finish here, is that what if you get a piece of paper that says, I'll give you that car for 7,000, and then you go to collect. Oh, I'm sorry. I misquoted my inventory. I don't have that. What happened? That's hopefully a good explanation of, backwardation and what it means and what it could.
David Morgan's message to gold and silver investors is both urgent and timeless. Don't get caught in leverage. Don't chase every rally. Focus on owning what's real. The margin hikes and manipulation can slow things down, but they can't stop the truth. Physical silver is running out, and the world is starting to notice. What happens if backwardation doesn't fade this time? What if one of the big bullion banks finally gives up and covers its shorts? Could this be the cycle where silver finally breaks $50 and never looks back? And how might gold react if silver leads the charge first? The answers to those questions could define the next decade of precious metals. Let's return to the full conversation to hear David Morgan's unfiltered insights, his warnings, his predictions, and what he believes is coming next for gold and silver investors. Watch the full interview, link below in the description. And remember, history is repeating, but this time the world is watching. The age of paper wealth is ending, and the future belongs to those who hold what's real.